Foreign investors are pulling capital from India at the fastest rate in nearly a year. At the very moment, the country's trade fundamentals are hitting a record high.
This report covers the market contradiction, India's record trade performance, the investor risk premium, and the tariff effect.
By the end of this analysis, the direct link between geopolitical risk and market valuation will be clear.
Let's start with the central puzzle. The Indian market is sending two completely contradictory signals, one of distress and one of undeniable strength.
On one hand, you have the investor sentiment. Foreign portfolio investors sold a net $2.7 billion of Indian assets in December. That pushed the rupee to an all-time low of 91.12 against the dollar. But on the other hand, look at the economic performance. November data showed total exports grew a massive 16% year-on-year, while the trade deficit shrank by 61%. Now, let's take a deeper look at that trade data, because it really does show fundamental strength.
The total trade deficit fell to just $6.67 billion. Now, to put that in perspective, that's a 61% drop from the $17 billion deficit we saw in November of the previous year, and that fall is all down to rising exports and falling imports.
A critical driver of this performance, as always, is the services sector. Service exports came in at $36 billion, which just blew past imports of $18 billion. That leaves a net surplus of $18 billion for the month.
That powerful services surplus is now covering 73% of the $24.5 billion merchandise trade deficit. That's a huge factor in balancing the overall trade picture.
So this is the big question, right? How can trade fundamentals be this strong while investors are pulling out at a record pace? Well, the divergence is explained by how markets price risk.
The explanation lies in a core financial concept, the investor risk premium.
Simply put, the risk premium is the extra return an investor demands to hold a risky asset over a completely risk-free one. It's the compensation for taking a chance.
And the relationship here is inverse. As the perceived risk of an investment goes up, investors demand a higher premium. This higher premium is then used as a discount rate, and that directly lowers the calculated present value of that asset.
So how is this premium actually calculated? Well, it's typically built from four distinct components.
Investors build their required return by stacking premiums for several factors. First, there's inflation risk, which, erodes future returns. Second is default risk, the chance a company simply fails. Third is uncertainty risk around future cash flows. And fourth, and this is key for our story, is country risk, which accounts for political and policy instability.
Let's look at a quick example. Imagine a hypothetical asset that's expected to generate 100 rupees in cash flow for 5 years. With a total risk premium or discount rate of 11%, those 500 rupees in total future cash flows have a present-day value of just 370 rupees. Notice how the further out the cash flow, the less it's worth today.
Okay, now watch what happens. If perceived risk rises, causing investors to demand just a 1% higher premium, so 12% instead of 11%, the valuation of that same asset falls. The present value of the same 500 rupees in cash flows drops from 370 down to 360. This is the exact mechanism that's driving the current sell-off.
And a very specific geopolitical event is what triggered this repricing of risk for India.
The trigger was a policy announcement from a major trade partner. The White House confirmed a new, temporary 10% tariff on Indian goods, and that directly increased the perceived country risk for India.
So the causal chain here is pretty direct. The announcement of new trade barriers raises that country risk component we just talked about. This higher premium leads to mathematically lower asset valuations, which then prompts foreign investors to sell until prices reflect the new, higher risk environment.
The market action we're seeing today reflects this repricing. The big question now is whether this is all just temporary noise or a permanent structural shift.
So going forward, there are 3 indicators that are going to be critical to watch. First, we need to see evidence that Indian companies are successfully diversifying their export destinations away from these tariff-impacted markets. Second, any further trade policy announcements from the U.S. or other partners. And third, and maybe most importantly, a stabilization of foreign portfolio investor flows in the coming months. That would signal that this new risk has been fully priced in.
So the market is now caught between these strong trade fundamentals and a heightened sense of geopolitical risk.
The upcoming foreign portfolio investor flow data for the next quarter will be the very first signal of whether this repricing is temporary or if it's the start of a much longer-term reassessment of India's economic path.